At some point in the last few years, someone told you to buy crypto. Maybe it was a friend who wouldn't shut up about Bitcoin at a party. Maybe it was an ad. Maybe it was a comment section full of people calling each other broke for not buying in earlier. And somewhere around the same time, someone else told you that crypto was a scam and you should just buy stocks like a normal person. So now you're stuck in the middle. You've got a little money you want to do something real with, and two groups of very loud people pointing in opposite directions. And the frustrating thing is neither side ever actually explains anything. It's just buy this, trust me, you'll thank me later. So let's actually do the thing neither side bothers to do. Let's look at both of them properly, what they actually are, why they actually have value, and which one genuinely makes more sense for someone building wealth from scratch in 2026. Because the answer isn't what either camp wants you to think. Before we compare anything, we need to get on the same page about one word: asset. An asset is anything valuable that can be transferred between people. Physical things like gold or real estate, shares of companies like stocks, digital things like Bitcoin, or even abstract things like skills or reputation. The key word is valuable, and what makes something valuable comes down to three things: limited supply, durability, and social agreement. Think of it like the three core stats in a game. If an asset scores high on all three, it compounds in value over time. If it scores low, it doesn't. Limited supply means scarcity. Things that can be endlessly created are worth less than things that can't. Real estate is limited because there's only so much physical land. Bitcoin is capped at 21 million coins, ever permanently by code. No government can print more of it. No central bank can inflate it away. That's the supply stat maxed out. Durability means it holds value over time and can be easily transferred. Gold is chemically stable and has been desired for thousands of years. Bitcoin exists on a decentralized blockchain that's nearly impossible to destroy and can be sent anywhere in the world in minutes. Stocks exist on exchanges you don't control, can't transfer directly to another person, and are entirely dependent on the continued existence of a company. And social agreement? This is the big one, is simply when enough people collectively decide something has value. Diamonds aren't inherently valuable. Gold isn't inherently valuable. They have value because enough people agreed over enough time that they do. And once that agreement is widespread enough, it becomes self-reinforcing. More people believe it, which makes it more true, which makes more people believe it. Social agreement is why Bitcoin went from nothing to $1 trillion asset class in 15 years. And it's the variable that separates crypto projects that will still exist in a decade from the ones that will quietly go to zero. Okay, stocks. Most people think they understand stocks because they've heard about them their whole lives. But most people have never actually thought about what owning a stock means. When you buy a share of a company, you own a tiny piece of it. Sounds great, except here's the part nobody talks about. For most major companies, owning that share doesn't actually give you anything except the right to sell it later and hope someone pays more than you did. Back in the day, companies paid dividends. If the company made money, shareholders got a cut. Direct payment, ownership that meant something tangible, but dividend payouts have been steadily shrinking since the 1950s. Today, some of the most valuable companies in the world, Amazon being the most famous example, have never paid a single cent to their investors in 30 years of existence. So what does owning Amazon stock actually give you? Ownership in name only. A number on a screen that goes up or down based on what other people in the market are willing to pay for the same number. That's it. The company can be wildly profitable, and Amazon is, and you still get nothing directly from that profit unless you sell your piece to someone else at a higher price. Which raises a genuinely interesting question. If stock ownership is just a number on a screen that has value because enough people agree it does, and the company doesn't owe you anything, how is that actually different from Bitcoin? Here's where it gets interesting, and where the people who dismiss crypto entirely tend to go quiet. The most common argument against crypto is that it has no underlying value. It's not backed by anything real, it's just made up, which is a fair thing to say, except so is a stock. The price of Amazon stock isn't derived from a formula that objectively reflects what the company is worth. It's derived from what buyers and sellers in the market collectively agree to pay. That's it. It's arbitrary social agreement dressed up in financial language that sounds more serious than it is. The difference with Bitcoin specifically, and this is the argument that serious economists take seriously, is the supply. Every dollar that has ever existed was created by a central authority that can create more whenever it decides to. Every stock represents a slice of a company that can issue more shares whenever it wants. Bitcoin has a hard cap, 21 million, coded into its existence. No authority can change it. No government can print more of it. In a world where the money in your savings account loses purchasing power every year because more money keeps getting printed, and we've seen exactly how aggressively that can happen, an asset with a genuinely fixed supply starts to look less like a gamble and more like a hedge. We covered this properly in our video on Bitcoin and inflation. Link is in the description. But here's what the crypto evangelists don't tell you. Not all crypto is Bitcoin. Most of it is not Bitcoin. Most of it is tokens with no real supply limits, no real utility, and valuations based entirely on hype and the hope that someone else will pay more tomorrow. These aren't investments. They're the financial equivalent of gambling on a random encounter in a game you've never played. The odds are completely unknown, and the house always wins. Bitcoin and Ethereum have social agreement. They have durability, institutional adoption, regulatory recognition. The rest of the market is a spectrum that runs from promising to outright fraudulent, and most people cannot tell the difference. Stay here, because the next section is where the actual decision lives. Not which one sounds better. Which one makes sense for where you actually are right now, with the money you actually have, and the timeline you're actually working with. That calculation is more specific than either side of this debate will ever admit. Okay, actual numbers. Because feelings about crypto or stocks don't build wealth. Allocation does. The S&P 500, the index that tracks the 500 biggest US companies, has averaged around 10% annual returns over the last century. Through recessions, crashes, wars, pandemics. 10%. Not every year, but averaged across time, reliably enough that it's the foundation of almost every serious long-term wealth-building strategy ever written. Bitcoin has averaged significantly higher returns over its existence, but with volatility that makes the stock market look like a savings account. It has dropped 80% from its peak, multiple times, recovered, hit new highs, dropped again. If you bought at the wrong moment and needed the money at the wrong moment, you lost badly. If you bought and held through every drop, you won enormously. The difference between those two outcomes is almost entirely psychological, and most people discover which category they're in only after the crash has already happened. Here's what the data actually suggests for someone starting from zero. A diversified index fund is your base layer. It's the safe respawn point. Low fees, automatic diversification, historically reliable returns, and you never have to think about it. Set up a recurring buy, let it compound, check it once a month. That's the whole strategy. Bitcoin, if you believe in the inflation hedge argument, and there are serious reasons to, belongs in your portfolio as a percentage you can afford to watch drop by half without panic selling. For most people starting out, that's somewhere between 5 and 15%. Not your entire stack. A position. One that could significantly outperform or could underperform, and either way doesn't destroy you. What you should not do is treat any individual crypto project the same way you treat Bitcoin. Most projects will not exist in 10 years. Most tokens are not stores of value. They're speculation. If you're going to speculate, do it with money you've mentally already written off, never with money you need. Here's something worth saying out loud because it doesn't get said enough. The stocks versus crypto debate has become weirdly tribal. like choosing a side in a game where both sides think the other team is stupid. And that tribalism is actively costing people money because it stops them from thinking clearly about what each asset actually does. The person who puts everything in index funds because crypto is a scam might be leaving genuine asymmetric upside on the table during one of the most significant monetary shifts in history. The person who puts everything in crypto because stocks are for boomers is one bad cycle away from watching years of progress evaporate. The people quietly building wealth aren't picking a side. They're using both tools for what they're actually good at. Index funds for the reliable long game, Bitcoin for the inflation hedge and asymmetric upside, and nothing else until they understand it deeply enough to deserve an opinion about it. The financial industry has a vested interest in you being confused about this. Confused people pay advisors. Confused people buy products they don't understand. Confused people stay in whatever they were sold first because the alternative feels too risky to figure out. But you've just heard the actual comparison. Not a sales pitch for either side. Not a guru telling you what to buy. Just the mechanics of what these things are and why they have value. Drop a comment. Are you team stocks, team crypto, or have you figured out it doesn't have to be either or? And if you've had a moment where you panic sold something and watched it recover without you, be honest about it because that comment will help someone else not make the same mistake. The question everyone asks is which one makes you more money? And the honest answer is it depends entirely on how you use it and how long you hold it. Index funds make you money slowly, reliably, and without requiring you to know anything about the market beyond the fact that it goes up over time. Bitcoin makes you money dramatically if you hold through the volatility and doesn't make you money at all if you sell every time it drops. Most individual crypto projects make someone else money at your expense. The real question isn't stocks or crypto. It's whether you understand what you own well enough to hold it when everything in you is screaming to sell. That's the actual skill. That's what separates the people who build wealth from the ones who tried to and couldn't figure out why it never worked. Both tools are available to you right now. No minimum balance, no special access, no gatekeeper, just the decision to understand them before you use them. This has been Cody Stacks. Remember, stack smart.